Okay, good morning, everybody. I'm sorry for the late start here. I had neglected to send out the link to this class session, so that's on me. I apologize. It's usually something I do as I prepare for every class session. For whatever reason, I didn't do it, so I just sent it, and obviously, you've got the ability to look at the video after the fact. But nonetheless, it's there, and so it's kind of on me. All right. So let's go ahead and get started here with where we are today. And one of the things I mentioned on Monday was the fact that we're in chapter 13 right now, which is a pretty lengthy, I think, very detailed chapter. In my mind, it's really the heart of this course. It really is, and it's got applicability across the business world in all kinds of different areas, marketing and finance and even things like personnel, which we'll get into here a bit later. But I personally wanted to take my time to kind of go over this. And so I mentioned in the class on Monday that I was considering strongly moving back the due dates for the chapter 13 activities. I'm going to do that. I'm going to move back to next Sunday. So you don't have to do it this Sunday, unless you want to, of course. And you're free to do a test drive if you like, and just sort of see how things go with regard to the particular homework and quiz and whatnot. So you're entirely free to do that. The reason I'm doing, and the other thing too, is the fact that this is one of the reasons why I like the 15-week sections, is because it kind of gives us a lot of time to cover the material that we need to cover, and we're not under extreme time pressure like we are on the 12 or even 7-week kind of format. So this is to your advantage. If you want to work early, that's perfectly fine. And I'll go ahead and make the change in bright space sometime later today when I get back to my office, and I'll do that. So, okay. So my plan is I'm going to finish up talking about the content out of chapter 13, that particular module, which deals with cost, volume, profit relationships. And I'm going to finish that today. And then on Monday, when we come back, I want to do a little bit of the exercises from the back of the chapter. And then we'll get into the next module, which is not really a chapter at all in your book, but it's an appendix, and it deals with what we call activity-based costing. And I think you'll find that to be a natural sort of add-on to what we're doing here. Okay. So anyway, are there any questions? We got a number of people on the Zoom call right now, and you can put your comments in the chat box if you like, but otherwise we'll move on. One of the things too that I know that I have a class at main campus that's going along sort of the same parallel track you are, and they're kind of remarking on the math that's involved. And I really do not want to belabor the math other than to illustrate the fact that we have to demonstrate things numerically in dollar terms, unit terms, percentages throughout this course in order to really give a full understanding of what's going on with respect to things like profit planning and budgeting and all these things which we're leading up to. So there is a logic to some of that. So, all right. So before we get going, we have two more sections to cover in this particular module, which is why I am sort of deferring the due dates for chapter 13's activities. We want to talk about targeted net income and something called margin of safety. And these are very important concepts because, remember, we talked earlier about this idea that, okay, what is our break-even point? And I sort of alluded a little bit to this on Monday in the sense that companies don't really exist to break even. And so why is break even a consideration? And it's a consideration in a lot of different ways. Number one, the thing that comes to mind, in my mind at least, is the idea that if you have new startups, individual products, new divisions, you're trying to get to break even. That's an objective. That's a goal. Making zero profits is a goal if you can finance the losses for a time. But also, as we'll see in this particular segment, it's also on the downslope as well. That is, what if we're losing sales? How much sales can we lose before we hit this break-even point? And break-even point is expressed in terms of units as well as dollars. Okay, So anyway, let's talk about this idea of break-even point. And this is the equation. This is the essential sales equation, remember. So we're going to go back. This is our Vargo Electronics example. $500 is the sales price. Remember, sales or revenue is price times quantity. Price 500, quantity is variable. And we see the variable cost per unit, $300 per unit times the quantity. And then we have fixed costs, which come out of that. And in this case, let's just say we're not breaking even, we want to get 120,000 in net income. That's where we want to get to. Again, let's forget about taxes. Let's not worry about that at all. And let's just sort of do the math, right? So we collect the terms here, right? And we're going to get 200Q, which is 500Q minus 300Q. And we're going to move fixed cost over to the right side because we're going to add fixed 200,000 to both sides. And we simply reduce this ultimately to quantity is 1,600. So what are we asking? What is this illustration telling us? It's saying it's an answer to the what if. If management says we need 120,000 in net income, what kind of quantity do we need to produce and sell, right? Remember, that's one of the assumptions we made earlier on was that all inventory produced is sold. There's no build up or drawdown, and that's it's an assumption which is an important one here for us to for the relationships to hold. And we're saying, okay, 1,600 units is what we need to do. Now, by the way, let's come back. And I like the fact that the textbook authors put these things in red because if you reduce this entire equation, what do you end up with? 200,000 is the same as fixed cost. And what is targeted and what is 120,000? It's targeted net income. And then $200 is the contribution margin per unit in dollar terms. So this is a relationship. It's an important one that we should understand that kind of leads us to being able to determine the what ifs. And the what ifs come up again and again and again in the business world in the sense of what do we need to do in order to get to some particular level. And in terms of one of the things that I think is important to answer here, because it comes up and students oftentimes ask the question, why do we need to target our net income? Well, I think we need to target net income because it goes to the whole issue of budgeting. And if we're not making a profit, then what is it? Why? What are we doing, right? And we're talking about for-profit enterprises. This is not CNN where we're not for profit. This is a for-profit enterprise. If we're not maximizing profit, then what the heck are we doing? And we have to sort of establish some sort of goal, some sort of strategic goal. In this case, it's 120,000 for this particular product, whatever it is. I think it's cell phones in this case. And so that's why we need to establish a goal. Okay, so the target is, and by the way, we're going to be building more on these relationships as we get going deeper into the class in terms of budgeting. And the whole idea of establishing a budget, which is a forecast, it's a roadmap for where we're going. Okay. All right. So questions about that before I move on to the next area here, because these are all sort of woven together. And I'm going to do a little bit of calculations here and hopefully to try to make these relationships more meaningful to the examples given. So let's go on to the next issue here, and that's contribution margin. And what is contribution margin? Again, let me kind of zoom back out to what we talked about, I think beginning on Monday. We said, what is contribution margin? It looks a lot like, at least from a dollar perspective, it looks a lot like gross profit. Gross profit though is a GAAP concept. Sales minus cost of goods sold equals gross profit. And they're analogous, but they're not the same. And the reason why is because in CVP analysis, we're trying to split up fixed and variable costs because the main thing we're trying to drill down is behavioral costs. And so if costs are either variable or fixed, we can classify them as such. And so contribution margin is basically sales, all sales minus variable cost. And that's contribution margin. Contribution to what? Contribution to two things: fixed costs, contribution to fixed costs, and contribution to profit. Okay, and so that's what's going on. So when we talk about contribution margin to get to a unit value, we can simply do this. And we take fixed costs plus the targeted net income and divide it by that unit contribution margin. Remember, it's 500 sales price, but it's $300 variable cost is $200 per unit. and we want to get to this $120,000 net income, right? Then we simply divide this and we get 1,600 units. And that's the quantity that we need to get to in order for us to achieve that particular goal. And for right now, we don't want to get into things like regulatory issues or taxes or whatnot. I think it's this is on its own. This is challenging enough, but that's, I think, what we're really looking at here. Okay, so and why are we doing this? Why are we adding fixed cost and target net income? Well, first of all, and by the way, I want to come back to something I said on Monday. There's a sheet in Brightspace that is a kind of a cheat sheet, and I want you to know this. It's a pretty good friend of yours. Use this. We do not want you to be feeling like you're out on a life raft in the middle of the ocean. You're not alone. We are here to help you, right? And so this is one of the things that can help you is this particular formula sheet. And if we talk about this idea, and if we go to contribution margin here, where fixed cost basically divided by unit contribution margin will get you to the break-even point. But if we want to get a target net income, we have to add that to this numerator here, and we end up with some numerical figure as to quantity. Okay. All right. All right. So in this case, we're saying, okay, $120,000 level. We know that's the dollar figure we want to achieve, and we measure, sales and profits in terms of dollars or whatnot. But we have to get there in the real world by using units. And so in this case, 1,600 units is what needs to be produced. What's this look like in terms of sales dollars then? Okay, so remember the contribution margin ratio, and which is basically this. Remember the contribution margin is $200 per unit on a $500 sales price, which is 40%. So if you take that fixed cost plus the targeted net income, you arrive at the sales figure that will allow you to get to $120,000 in profit. This is beyond break even, because remember, break even was, I think, was $500,000 was the sales dollars that you needed to get to in order to make no profit, no loss. That's break even. And then beyond that, then you can get to some sort of dollar figure, and that's 800,000. Okay, and that's an important relationship here. And what I really like too about this is the idea that you've got this particular example of a graphical representation. I'm gonna go over this a little bit, and I'm gonna do a little bit of math and kind of see what's going on. So, all right, this is a new what if. So let's clear the decks and start the new what if. Now we're saying, okay, what if? All right, what if we're not doing whatever? We're going to do 1,400 units. And we're going to say that the sales line, which is this guy here, this blue line, because zero sales or zero profit, and it goes up. And the cost line, remember, we've got a fixed cost element, which is here, 200,000, right? And it's kind of fuzzy here, but and we've cut off the three digits, but it's 200,000. And then the variable costs go up here. The break-even point, obviously, is the point at which revenue is cost, which is this figure right here. So in this case, the question is, suppose Vargo sells 1,400 cell phones. The CVP graph, which is this, shows the vertical line intersects the sales line at 700,000 and the total cost line at 620. The difference between the two amounts represents the net income, which is going to be 80,000. So different example, different, obviously a lower amount of output than what we just looked at, but still a profitable area. And the profitable area here is this sort of little isosceles triangle that if we wanted to compute the area of this, we could and give a dollar figure. And we do that all the time in microeconomics in order to arrive at what the profitability is. Okay. And so let's just talk a bit about this relationship, because I think it's important for us to sort of understand the basic sales equation. So I might kind of take this down a bit here, and I know that I've been looking at some of the YouTube videos. I just basically upload these YouTube on my channel, and I know the sound quality is not great in this room, and I wish it were the case, but it's not. So I want to do a little bit of calculation here, and that's dealing with this particular relationship. And that is, so what do we got here? What is the basic sales equation that we can talk about? It's basically this. It's So it's $500, which is sales price, times the quantity, right? So 500 Q minus variable cost, which is 300 Q, right? $300 per unit. And then minus 200,000, which is the fixed cost element, equals net income, right? Which we'll sort of abbreviate as that. So what was the example we were just given here? It was a different example than the original one. It was just some what if, and that's if we want to do this number of units, what kind of profit will it be? So, and the example given was what, 1,400, right? So let's just plug in 1,400 everywhere we see a Q. So we have $500, 500 times 1,400 units minus 300 times 1,400 units minus $200,000 equals net income. And we're going to get to the same place we got before. I assure you the math is going to work, but it's just kind of a way for us to sort of lay this out. So if we do the math here, we get what? We get 700,000 in terms of revenue, and we have variable costs, which come out to 420,000. I'm just simply doing the math here, minus 200,000. And we're going to end up with what? We're going to end up with 80,000. Okay. So 80,000 is a net income based upon the what if of 1,400 units sold. And again, I know I've said this a number of times before, but the issue is that we are assuming that sometimes these are not good assumptions, but we're assuming that the cost per unit are going to be relatively stable in the relevant range of activity, and the fixed costs are going to be relatively stable. So we've got stability, and if it's not stable, then we have to deal with that. That's something we will have to manage. And I think it's important for us to realize that sometimes costs are not stable. And in this environment where we've, in the last couple of years, had some inflationary pressures, certainly in terms of wages, materials costs and whatnot, I think it's not always a great assumption that we're always going to be stable, but nonetheless, if things change, we will have to change our assumptions. And if our assumptions change, we have to rework the math. And that's just the reality, okay? All right, so questions about that before we move on to the next area here. All right, I want to kind of bring this back up. I know this is not a great system here, but I do want to talk about sort of where we go from here with regard to this notion of profit planning. And by the way, one more thing I'll say about this is I really like this a lot because I think this sort of, I know a lot of us are visual, and I think sometimes seeing is believing, and we like to see it in sort of a graphical form. This is a pretty good way to see it because it's this idea that you're producing, but you're losing money. You got to get to this thing here before you start making money. And that's an important issue. And there are lots and lots of companies out there, and we've talked a bit about that before, that are not to this point yet. They're somewhere quantity-wise below that. So to sort of get to scale, in other words, is an important characteristic, trying to get to the profit point. And you can't earn profit until you exceed break even. And once you exceed break even, then a lot of good things can happen. Okay. All right, let's move on. So, quick question here: mathematical equation computing required sales to obtain target net income. Well, it's got to be B, variable cost plus fixed cost plus target net income. So that's the answer there. So let's move on a little bit and talk about something called margin of safety. And I have alluded to it a little bit as we started, in the sense that, okay, break-even analysis is important, not just from the standpoint of those operations trying to get to break-even, in other words, trying to ramp up sales and volume to get to that point. But what if you're already at that point and beyond it? And how far can you fall before you get back to break-even? So this is not a minor question at all, and it comes to begin. So what is margin of safety? First of all, we can express it in terms of dollars, right? And it's simply the difference between the actual and expected at break-even. If we know what the break-even dollars are, I think it's 500,000 in sales for the variable example. And what does it do? It measures the cushion that we can lose, right? And we can express it in terms of dollars or as a ratio. We're going to look at both cases here. And so, yeah, 500,000 was break even sales. So if we, just as an example, we have 750,000 sales, and we know a break even point is 500,000, it means our margin of safety is 250,000 in sales. Meaning that before we start losing money, we can lose 250,000 in sales based upon all these assumed cost conditions. Okay. And it's important to know, particularly because what if we want to add to cost somewhere along the line? And what if, again, what was the scenario I used on Monday? We have a sales manager who earns 100,000. Well, if you put $100,000 into this, you're going to reduce that margin of safety a bit. And I'm not saying it's not a good thing to do. Maybe it's a great thing to do, but you have to understand what your safety margin is. So this is a dollar expression of how much we can lose, but we can also express it in terms of percentages. And all we've really done here is taken that dollar figure, which we had before, divided by back the expected sales. We have a margin of safety ratio of 33%. Now, whether you think that's a particularly useful measure or not is up to you, I suppose. I think the dollar figure sort of is a little bit more meaningful, at least in my experience. But there's no question, though, that the higher the dollars or percentage, which are going to go in the same direction because they are based upon the same relationships, the greater the margin of safety. So the more you have blown through break even, the better off you are, at least for the long run, if you're a company that seeks to maximize profit in the long run. And I think that we have sort of established the fact that for-profit companies want to do that very thing. They want to get to the maximum amount of profit they can get. And some of this is based upon what an expected amount of sales is going to be, and hopefully with some realistic assumptions as to how these sales figures are arrived at. Okay. All right. Any questions before we kind of move on here a little bit? Okay. So we talked about margin of safety as a dollar figure, and we talked about it in terms of a ratio. And so let's take a little example here. What have we got going on here? We have the Marshall Company, different example. You like the way we kind of move around between different examples. So we have Marshall Company actual sales of 600,000, when the break-even sales are 420. In other words, that's the point at which what total revenue is total cost, right? So we can just eyeball that and say, well, it's 108%, but that's not what I'm sorry, 180,000. That's not what we're being asked for. We're asked to compute the margin of safety ratio. So why don't we do that? And just as an example, this is a fairly straightforward one. I don't think there's anything too complicated about it, but I think it really does lay out the case for how we get to the margin of safety ratio. So let's go do the math on this. This is one of your examples in the text itself. So if we have, let's just kind of lay out the facts here. We have expected sales, right? And sales is always expressed as a dollar minus the break-even sales, right? The break-even sales, where we're at zero profit, and equals the margin of safety in terms of dollars. I'm going to express it here in terms of dollars. I know we need to get to percentages, and we will, but let's do this first in order to get there. So what are the expected sales? There were 600,000, right? And the margin of safety, I'm sorry, the break-even point sales were 420. So the margin of safety is 180. And again, that was not overly complicated because we saw the math just a second ago. But the question is, what is the margin of safety ratio? And that's what we are really being asked to produce here. So we're taking this dollar figure then, and we're going to take margin of safety sales on the very right side here. Margin of safety sales as a dollar figure, and let me just kind of keep the same methodology as a dollar figure, and we're going to divide it back by expected sales. Okay, and so let's just plug the numbers in. It's not too complicated. It's 180, which is what we just calculated over here, 180,000 divided by expected sales of 600,000. Then we end up with a figure of 0.3 or 30%. whatever you want to, however you want to reflect that. Okay. So it basically says we can lose 30% of sales in order, we can lose 30% of sales until we get back to break even. That's really what this is establishing. Okay. So it's an important relationship in the sense of what is this cushion amount, and we've established a cushion amount both in terms of dollar figures as well as percentages. For those who like percentages, sometimes those are important, and we can do a lot of things with these numbers in order for us to do what is really the ultimate goal, to earn maximum profit. Okay. All right. So any questions? And I'll leave that up there, but of course it's on the video, so you'll be able to see it and stop it and all that kind of good stuff there. So let's kind of move ahead here and talk a bit more about margin of safety. And here's the answer here. So 30%, that was obviously that's the answer we arrived at. And I know that I've said before that I don't always take a lot of time in class to do these sort of breakout do it examples, but I think in this case it makes a lot of sense for us to do it if it helps us understand what's going on. And you know, I think sometimes working in relationships makes a lot of sense. I've long believed that to really understand accounting, you have to do accounting. And so let's kind of do this one. So here we have a company making travel bags selling for $56 each. So that's the price. Okay, remember that. Fixed cost $320, that's given, and variable cost per unit is $42. So we know we have a unit contribution margin of $14. That's not particularly complicated there. And so we're being asked to do three things: compute the break-even point in sales dollars using the contribution margin ratio. So remember, this contribution margin ratio is simply expressing contribution margin as a percentage of sales, net sales, right? And we can determine what the break-even point is. We can also determine the margin of safety, assuming that we have sales of this figure that's sort of given to us. That's part B. And the final one is the sales dollars that we have to get to earn net income of 410, which is the targeted net income. All right. So why don't we do this? And I'm gonna take this down a little bit, and let's kind of work the math so that we can kind of get to this point here. So I'm going to go ahead and erase what we've got here in order to do this particular problem. Okay, so all right, so what are we trying to do here? Let's just kind of zoom back here. We have three things we want to get to: part A, B, and C. And I want to kind of stop to kind of refresh my. So break-even sales in dollars. Let's do that first. Okay, so break-even sales in dollars. Well, first of all, we let's compute a contribution margin percentage. Okay, or the contribution margin ratio is how we're expressing it in text. So contribution margin ratio is basically what? It's the contribution margin per unit, which we already looked at. It wasn't particularly complicated, and it's divided by the price. So what do we have here? Well, we have contribution margin is, and I'll break this out as well as I can, variable cost per unit and all of our price. The price was given at 56. The variable cost per unit at 42, divided back into 56, and we have what? We have 14 over 46 equals 0.25 or 25%. Okay, so it means that for every dollar of sales, we're generating 25 cents in income that before fixed costs, before all fixed costs. Okay. All right. So what are we going to do with this then? Well, the break-even point then is, which was what we're really being asked for here. The break-even point in dollar terms is basically this. And just remember this relationship. It's not all that intuitive, I don't think, but fixed cost over the contribution margin ratio. And it's the reason I keep coming back to this sort of cheat sheet is because it's there and you can use it. And if you want to refer to it, it's important to refer to it. And so what do we really have going on here? So we're saying, okay, what are the fixed costs? The fixed costs were given, at 320,000 in this example. And we just calculated the contribution margin percentage or contribution margin ratio at 45%. If you do the math here, you end up with 1,208,000. Okay, and that is essentially the break-even point in terms of dollars. And we'll kind of work this as a bit of a proof here in just a second. Okay. So any questions about where I got this? And by the way, the derivation of this particular formula is something we got to a little bit earlier. And if you do have questions about this, where this came from, get with me. I'm more than glad to discuss that and sort of go over that. Okay. All right. So that's the first part, 1,280,000, right? And what we're being asked for here in this example, it was in part A, it was asking about break-even point in dollars, and that's 1,280,000. So that's part A. Okay. Let's go to part B. And part B is that, oops, I shouldn't have taken that down. Part B was asking us to do the margin of safety and the margin of safety ratio, assuming actual sales are 1,382,400. Okay, so let's do this as part A of this example, and let's go to part B. So part B is asking us about margin of safety. So margin of safety in dollar terms, right, is basically this. It's the sales minus the break-even sales, right? Sales minus break-even sales. And we're given in the problem itself, it just comes to us sales of 1,382,400 minus the break-even sales, which we just computed there, of 1,280,000. So we kind of do the math here. We're going to end up with a margin of safety dollar figure of 102,400. Okay. Meaning that we can lose 102,400 in sales before we drop down to break even. Okay. But the other question is, what we're really getting at, and what is really mostly asked for here is, what's this? That's one part, but also margin of safety ratio or percentage, which is simply computed as, in this case, the 102,400, which we just calculated, divided back into the sales figure of 1,382,400, and it's going to give us a figure of 0.074 or 7.4%. Meaning we can lose this much percentage of sales. Again, I don't know how valuable the percentage is, but sometimes people like to use it, and sometimes there are some shortcuts we can do with percentages in order to arrive at some of these values. And we'll talk a bit more before we leave about the value of using software to kind of do your work for you. But that's an important consideration. Okay. All right. Any questions about A or B before we move on? We have one more question. That's the sales dollars required to earn a net income of 410. All right. Well, here we're being asked, we don't really care about the break-even point or margin of safety. What we're really interested here is to achieve a targeted net income. Okay. So in other words, it's the sales that gets us to a targeted net income. So we have to arrive at a target sales. And the sales are basically going to be fixed costs plus targeted net income, right? And it's going to be divided by the contribution margin percentage, right? So let's do the math here. And this is the variable target sales. So we have fixed costs, which were given in the problem, of 320 plus targeted net income, which is 410. That's given as the objective, and we want to all over the contribution margin percentage of 0.25. You're going to get here 730 divided by 0.25, or basically multiplied by 4, and you're going to get 2,920,000. That's the sales that we need to get to achieve the targeted net income of 410. Okay. This answers the question of how do we get to the point at which we get to that 410 level, we have to do this much in sales. And so these targets are objectives, they're goals, they're laid out by management, and very often it's the case of, okay, just go do it. you got to get this amount of sales for us to do this amount of net income. If you go over, fine, it's great. But if you don't meet it, it's not so great. Okay, so that's really what is essentially going on there. And one final thing I want to do here, I kind of want to do a bit of a proof. I don't know if I have time to do that. I was going to kind of work a proof, kind of working this backwards by taking sales, what is variable cost, what is fixed cost, etc., to get to net income. And if you want to see that, I'll give it to you. But I do have a strong interest in sort of getting through the rest of this right now. But and I don't want to, overly tax everyone in terms of the math. But there are ways that we can sort of check our math, okay, and work this a little bit backwards and make sure that the numbers line up and whatnot. The good thing about software is obviously the fact that we'll do a lot of this for us and make sure the numbers are right. So any questions about this example from the text itself? All right, let's move on here and we'll sort of talk a little bit more about margin of safety. We'll sort of wrap the margin of safety piece up here a little bit. And so, and here are the answers. And of course, these are what I just worked on the board. The break-even sales were $1,280,000 based upon what we know about contribution margin. And again, the contribution margin math is relatively straightforward. Price, variable cost per unit, but back into price gives us 25%. If you take the break-even, we have fixed cost divided by contribution margin ratio. That's the formula. And on the board, that's it. Highlight, put a star by. You get to 1.28 million, and that's the break-even dollars based upon these relationships, which we hope are relatively stable. And in terms of dollar amounts, the margin of safety is based upon some assumed sales of 1,382,400. What is our margin of safety, which again is expressed in both dollar terms as well as percentages, and those are really what we just calculated there. So again, margin of safety is simply this idea of if things begin to deteriorate, I guess you could say, where do we end up? And then the final one was the profit, the target net income at 410. And how do we get to, so what is the sales required to get us there? To fixed cost plus that targeted net income figure divided by the contribution margin ratio, and you get 2,920,000 to get to the targeted net income, which is 410,000. Okay. And so that's how we sort of worked with that. And what I would encourage you to do, and I'm a firm believer that there's benefit in sort of working the problems in the back of the text. The good news really is the fact that the answers are mostly there. If you want to click on the button, and you can get the answers and get feedback and explanations. And don't get frustrated if you are missing some problems. It's all part of the learning process. And this is not the most straightforward information that you've probably ever heard before, but nonetheless, it is pretty important for us to discuss this in the context of what we're trying to do. Okay. All right. Any questions? I'm sort of looking in the chat box. I don't see anything there. So why don't we move on to talk about the final go around here, and then we're done with chapter 13. And then when we come back on Monday, I'll do some more problems, and then we'll move on to the next unit, next module of Appendix F, which is activity-based costing. We're going to talk about this idea of what we do about mixed costs. And up to this point, I said that we would sort of elaborate a bit on this primitive technique that we talked about in terms of the high-low method, in order to bring a little bit more rigor to the question of what do we do about separating fixed and variable costs. Separating them, why? Because the costs are mixed, and if they're mixed together, how do we pull these apart so that we can do a proper cost volume profit relationship? So let's talk about this. First of all, let's go back to the high-low method, okay? And this was I think the bus company, right? And It seems a while ago when we talked about this company. And if you just look at the data, it was volume data, it was dollar data, cost data, and we're assuming maintenance costs are the only fixed costs on this. Then these are the quantity figures here. And notice they kind of line up pretty closely. It's a pretty tight distribution. So the high-low method in this case is probably not the best, but it's probably not the worst either. And this idea of distribution of data is an important issue, and I don't believe that stats is required before we take this course here, but if you take statistics, you'll see there are all kinds of distributions where the data is all over the place, and it becomes very hard to make any kind of sense of it, any kind of relationship. In other words, it's got a very high variance from whatever kind of mean whatever kind of average value you're trying to get. And by the way, if we're going a straight line, we're assuming that the relationship is linear, but it's not exactly linear because you get values that don't fall in the straight line itself. This is a pretty good distribution, I'm just eyeballing it, but it's not the best we can do. And one thing I want to be clear on is that you don't have to have had stats before in order to really be able to work what we're doing in this particular segment of the class here. And all we're trying to say is that the high-low method has got its disadvantages. Because what we're trying to do is, take the high and the low, we're sort of bracketing the values of both volume and cost and saying, okay, here's high, here's low, whatnot. But what if high is really, really high? What if low is really, really low? Then you got a problem there. So, and that's kind of a thing. It's kind of an issue, right? So we need to be a little bit careful, I think, about this. So, here's a different example. Your textbook authors like the trucker example, so or driving or whatnot. So miles, quantity, and dollar cost here. And you got 12 months of data as opposed to 6 months before. And so if we lose the high-low, and this is when high-low may not be the best method at all. So we just simply say, we find out what is the high activity, what is the low activity, and the cost should flow from that. From that, then, what is the first step? We have to pull out variable cost per unit. And then once we have that, we can arrive then at the fixed cost, which allows us then to construct an equation that we hope is linear and, in other words, a straight line. And it lays out for us along a spectrum, along the range of activities along this horizontal axis, what we can expect to see in terms of cost, right? And that's an important thing for us to do because we know that activity varies throughout the year and over time and whatnot. So, all right, so in this case, what do we have here? So we have a high and low, and so it looks like the high is 63,000 in April, and that corresponds to 50,000, and the low is, what is it, 20, what's the low here?
July.
What's that?
It's the July.
No, it's July, okay. Maybe I'm too close to the screen. So the low is 15,000, right? Which is quite a bit lower, frankly, than the April figure, and 39,000, okay? So remember what's going on here. We're trying to take the change in cost over the change in activity level, right? So you have the high in April, 63,000, the low in July, 39,000. Subtract those, that becomes your numerator. And then the quantity is 65,000, which is, oh, no, the slide is wrong. It should be 65, right? Well, anyway, it's, I'm sorry, the slide's wrong. Minus 15,000. And so if you do the math here, you're going to get, so 63,000 minus 39,000 is 24,000 divided by the difference here, which is 65 minus 15 is 50,000. That's the denominator. And you're going to get 48 cents per mile. In other words, that's the variable cost per unit. That's the variable cost per unit. And so, and that's the key thing to know here. And again, with the high-low method, I want to sort of reiterate something here. You probably have this in your notes somewhere, but basically what we're doing is we're taking the change in total cost here, right? Divided by the change in quantity in both the high and low methods. And so what is the change in total cost? It's the total cost high minus total cost low divided by the quantity high and the quantity low. And that's all we're really doing here with this relationship, okay? So, and because we're trying to get at, remember, the whole purpose is to pull apart here the different elements of cost between variable and fixed. So we got one piece of this so far, and that's the 48 cents per unit that we can establish as what we think is hopefully a stable relationship between miles driven and total cost. So it basically says to management, it costs us 48 cents to drive a mile, okay? Based upon the high-low method, we're going to talk about the limitations there, okay? And then if we want to sort of work the math here and do to arrive at the fixed cost, remember, the first step is to determine the 48 cents per mile. So in this case, and we're just going to take one of the two. You can take the low equation, you can take the high equation, it doesn't matter, you're going to get the same values, right? And in this case, the example is we're going to take the low activity level, which was July, right? And we're going to say, okay, 15,000 miles driven, that's the quantity, times the variable cost per unit of 48 cents. And what's that going to give us? Well, if whatever that product is, if we subtract it from fixed costs, we're going to end up, from total costs, which were, we're doing the low, aren't we? Oh, 39,000, we're doing the low. 39,000, total cost minus this relationship of variable cost per unit and units, you're going to get 31,800. Those are the fixed costs, because remember, what we're trying to do is we're trying to extract variable from fixed, and this is one way to do it, using the high-low method, okay? So, but we could do it the same thing. We could use the high month of April and do this very same thing. And I could walk you through that, but in the interest of time, I don't think it's a great use of time to do that. But it's the same thing. We're obviously going to get to the same level, and we're trying to determine what the fixed costs are. In this case, it's 31,800. Okay, given the high-low method. And so, what is the equation then? Okay, so remember, when we're trying to plot these cost equations, we're saying, all right, if these are all the costs, total costs here, we have the fixed cost element, which is the intercept of the vertical axis, and we have the variable costs, which are what? If miles driven is multiplied by 48 cents, then 48 cents, it must be the slope of that function, right? And this fits the formula of y equals mx plus b. Just a little bit, we've sort of inverted these two last terms. It's the slope times the quantity, right? And then this is the intercept, the b in that generic algebraic relationship. So we have an algebraic relationship that says 31,800 is the intercept, and the slope is 48 cents per mile times whatever miles driven, okay? Which are variable, and that's why it's a variable. It's going to change over time. So that's the high-low formula. And so is that good, bad, ugly, whatever? Well, I don't know. Here's the thing. We're not on this example of Hanson trucking. Look where the data lies. It's not exactly on the line itself. In other words, it's fairly widely dispersed. In other words, we say there's quite a lot of variance. It's not the worst distribution I've ever seen, because if you take the blue line away, you could probably get an idea that these are directly related, positively correlated. In other words, dollars and units on this axis here. But they're more dispersed than what they were on the other example, the Metro Bus Company. So, and this is based upon the high-low relationship. All we've done is simply plotted ordered pairs. What do you mean by ordered pairs? Well, I'm simply saying these guys right here. We're just simply plugging in numbers on the horizontal axis and on the vertical axis, horizontal, vertical, and we're simply putting those in to the graph, and this is what we've got, okay? And by the way, Excel and all other manner of software will plot this very, very easily, and if we had more time, we would sort of go over that, but it's an important way to illustrate this from a graphical standpoint. Okay, so what about this? All right, this may not be the nicest plot, and we've established 31,800 as intercept and 48 cents as a variable cost, which is the slope of the function, right? Well, here's the thing. All right, so take a look at this. At 19,000 miles, you've got that it predicts that we're going to have 40,920. That's fixed plus variable cost per unit. And the high-low equation does not really provide that great of a representation. And again, my language here is because of dispersion or variance, which is a lot. So what's the answer to this? And I know that we sort of are a little bit out of our comfort zone here in terms of bringing in statistics, but I think it's really important for us to do it. And that's something called regression analysis. And regression can be done through a lot of software, and it's going to give us much more precise measures. And so what is regression? I know that a lot of people have never come across this term before. It's really a statistics term that's used by mathematicians and anybody who uses lots of data. What regression really is, and first of all, where does the term come from? As I understand it, it was during World War I, the British were measuring men so they could produce uniforms. And they noticed that you'd have one guy who was really tall, and then one guy who was not so tall. But as you introduce more observations, you would sort of get to some sort of average height. And in other words, they would regress back to some average, or what we call mean, right? And what is really important about this is the idea that the more values you bring in to any kind of statistical analysis, you're going to end up at some sort of average that is much more representative of what's going on. And when we talk about this, regression analysis allows us to get to what we call, one method is called the least squares method. And I don't really want to get into that so much, but other than to say that why are we calling it least squares? We're talking about the difference between what we expect and what the average is, and what the observation is, what the average is, and we square these to get rid of the negative sign. So some are going to be above the line, some are going to be below the line. If we square them, we get rid of the negative sign. Okay, that's all it's really going to do. I don't want to dwell too much on that. If you want to give me a call, we can certainly talk about that. Here's the point. The point is that this is going to arrive at a cost equation that's much more representative of what the data is showing us. Because here's the limitation and the real disadvantage that high-low has. High-low really just says, okay, we're going to sort of bracket observations, take the high activity, high cost, the low activity and low cost. But what if this activity is really, really widely dispersed? It becomes a real serious problem. And this idea of dispersion of data is an important consideration. And look, these have got real life sort of consequences. One of the things that I was thinking about earlier was this idea. The first house that I bought, I built, it was on a new development, and they're going to assess. They're forming a homeowners association, and they're going to assess every homeowner a certain dollar amount based upon the value of their property, which was not a particularly scientific method, but it was a very quick and dirty calculation that appraisers would do. And the final lot was somebody bought. It was a very nice lot, but the house that this person built was gigantic. I literally was probably 10 times greater than the average property value. So it was an outlier. And what do we do with outliers? Well, we have to figure out what to do with it. And but that's a real life sort of problem that comes along. And we have a way to deal with this kind of thing. Okay, I want to go to real quickly here to the text, and I can pull it up here and bring this over. This is in 13.2-25 in the text itself, chapter 13. And we got the answer trunking example. We have miles driven. We have total maintenance costs right there. And notice this looks like an Excel package. And notice this, boom, intercept 18,512, slope 0.81. Those are different numbers, right? Those aren't the same intercepts we had before. And the reason why is because we're using a regression formula, which in a couple of keystrokes or a couple of clicks, you can get there. But it's different, and it takes into account the variance between what is actual and and then what sort of becomes average. And that's what regression really is about. So if you're going to scroll down here a little bit, one thing I want to point out is this. Okay, so all right, so I really like this graph line. This is right out of your text itself, and so if you are looking at a regression equation, you have an intercept here of 18,502, which is down here. Oops, that's not quite the same, right? These are different intercepts. The high-low method gives us an intercept of 31.8. That's a pretty big difference, right? Also, the slope in the high-low method was 48 cents a mile, so it's a little bit flatter slope. Using regressions, 81 cents, a little steeper slope. So you have a lower starting point but a steeper slope. And notice the data falls a little bit better on this line. Nothing is really perfect, and there's always going to be dispersion of data, and that's just kind of the way it is. And if you're a real stats junkie, you really like this a lot. But you got two different formulas here, and that's really the issue is we have two different linear equations to describe the very same phenomenon. None of the data has changed at all. It's the way that we interpret it. The high-low method's got shortcomings. We have a much flatter slope and a higher intercept with a regression analysis match, a lower intercept and a much steeper slope. So which is more accurate? And we're going to argue that blue line regression analysis is more accurate because it takes into account this idea of all the data, not just the high and low. And that's really the big shortcoming with high-low analysis is that we do not have enough representation of data. And that's really what's going on there. Okay. So it's an important relationship for us to kind of be aware of. And again, I come back to, and on the slide package itself, we just get into this idea of different intercepts and different slopes. And so, and by the way, these are pretty different equations. I mean, you're talking the same observation of data, and I mean, we are starting at different places here and have different slopes. And so this is why high-low has got its relationships. And I brought up the whole issue of the housing project and all that, because what do we do with outlying data? Sometimes one technique is just simply get rid of it, right? And it doesn't make any sense to include it because it's a real outlier. Outlying data or outlying data points are problematic. Sometimes we just have to kick them out and say, you're not representative of what we're trying to establish, which is a functional relationship between output and cost. And whatever you are, you're not really sort of fitting the mold. You built this 10 times more valuable house on our development, so you're not really representative at all of what's going on. No one's discounting its existence, but we're trying to establish a functional relationship, which is a linear relationship based upon cost, intercept, and slope and quantity. Okay. All right. I think we're kind of running out of time here. I was going to kind of get into some of the problems for this section here. Have I gone through? And this is sort of what I talk. Oh, and one final thing here is this idea of outliers that I sort of mentioned. So anyway, this is all in your slide package. But I was going to get into some examples of back of the chapter problems. The first one I wanted to do was going to take me longer to set up than what I really have time for. So we're a little bit early, but I've been keeping you guys later, not by design, but as sort of happened. So I think I'm not going to do that. And so when we come back Monday, I think we'll get into some examples of inter-chapter exercises. I will adjust the due dates for homework, quiz, and bonus for this chapter 13 module to next week. If you want to do it early, fine. You're more than welcome to do that. It's always good to work ahead if you feel like you need to do that. But I'm a firm believer that I think sometimes accounting just takes time to do. And don't rush yourself. Don't beat up on yourself. Don't be hard on yourself. If you're having trouble, let me know. And I mentioned at the outset that we do not want to put you on a life raft in the middle of the ocean, that we do have support, and take your time, okay, with these problems. All right, so we have about 6 minutes, and I think that's about all that I'm going to go over today. Are there any questions that I can answer? Let me pull up the Zoom room here. What did you guys get? All right, are there any questions for me, anybody on the Zoom call or here in class? All right, if you have questions for me, feel free to get with me. We've got some time to do this. Again, I think this is really the heart of this entire discussion. Chapter 13, I think, is the sort of the centerpiece of what we're doing here. And then as we go forward, we're going to get into some other examples of what these tools have in terms of utility for solving all kinds of other business problems. Okay. All right. Well, have a great weekend. See you next time.